Federal Reserve Bank of Kansas City said this week non-real estate farm lending during the first quarter of 2016 was higher than normal. The report says the total volume of lending in the first quarter was the sixth highest since 2000 and more than 20% higher than the average of the past 15 years. The KC Fed also believes the increase it sees in farm debt is being used to finance short-term needs with narrow margins. Creighton University's Rural Main Street Index shows for the 8th straight month, rural bankers across a 10-state region have an outlook below growth neutral. Gregg Ibendahl at Kansas State University's Department of Ag Economics has been tracking debt financing in agriculture. We talked with him earlier this week about the health of farm finances and began by asking about the current level of agricultural lending.
Well, currently we're about $70 billion per year to loans to agriculture. Now, if you look at that on nominal terms, that's up, certainly a historical level. But even if you go back and adjust those numbers to account for inflation and put things on real dollar terms, that $70 billion is still probably close to a record level for lending to agriculture.
Have delinquency rates began to tick up at all?
Well, actually, no. They were certainly very high during the midst of the farm crisis, but they have continually come down. And right now, if you look at the delinquency rates, we're probably at a historical low. We're certainly well under 1%. But as I kind of mentioned in some of the writing I've been doing here at K-State, I think the delinquency rate is really a trailing indicator for problems in the financial sector.
Explain why that is.
Well, I think farmers usually they'll try to pay off their debt as much as they can with the dollars they have, even though they may have to start cutting back in other areas. It's not till we see that the problem has been going on for a couple of years that we'll start to see the debt delinquency rate start to tick up and become a problem. So the fact that it's low now doesn't really mean farmers are necessarily in good shape. It just means they've been taking the resources from other areas and making sure they pay down debt. But sooner or later, if they cut back in other areas, it's going to come back and affect their loans as well.
Do you think the debt to asset ratio is an important one to look at if you're looking ahead for signs of problems?
Oh, definitely. Usually we use that as our main source as far as how much leverage a farm has. We can kind of look at the debt to asset ratio as really as a way of measuring how much of your farm a lender actually controls. So if you have a debt to asset ratio, for example, of 30%, that basically says that your lender controls 30% of your farm business. Now, what we saw in the early 80s, though, was the fact that when the farm crisis really hit, farmers really had pretty low debt-to-asset ratios. The reason why the debt-to-asset ratios ended up going up during the midst of the farm crisis was because asset values went down thanks to low farm prices, and as asset values went down, that took down the farm equity. And even though farmers didn't add any debt to their businesses, the fact that the equity levels went down, the asset levels went down, the debt-to-asset ratios ended up going up. But that was really a trailing indicator for what was really happening, meaning it went up after we saw some problems already happening in the financial sector.
Right. What role are land prices playing right now, being so historically high and now starting to retrace a little bit?
Well, that's kind of one difference between now and the 80s is we saw a pretty quick drop-off in land values when we saw some lower farm values and farm incomes. But right now we really haven't seen that. So we've seen some couple of years of lower net farm incomes. We've seen a little bit of retreat in land values, but certainly it hasn't been near as much as what we have seen in the early 80s. But yet I think a lot of that story is yet to remain written yet.
What do you think would be an indicator that maybe there is trouble up ahead?
Oh, I think you're seeing some of that now, just the fact that we are seeing so much lower net farm income. In fact, if we look at some preliminary results from our KFMA farm numbers here in Kansas, we're seeing net farm incomes this year, kind of like, probably anywhere from 10 to 25% of what they were last year. So we're seeing some big drop-offs in net farm income. I think farmers have built up some reserves over those good years from 2007 to 2012 where they were able to build up and save up some savings. But I think you're seeing farmers tap into that right now here. So it's only a matter of time before they can keep using those resources before they get themselves in real trouble.
The big question then, Greg, what should producers be doing to appropriately position themselves going forward?
Well, certainly watch spending as much as you can. Certainly control any additional borrowing. I think lenders going forward, if they start to see debt-to-asset ratios go up because of maybe asset values going down, that they'll start to look harder at a farmer's balance sheet. So I think farmers really need to watch their expenses, watch how much they take on debt. If they do see some additional land come up for sale, maybe they want to think twice about where they actually want to borrow that, or maybe look at renting as an option. Certainly renting won't add to their debt-to-asset ratios like purchasing farmland will.
The USDA's current projection shows a 2016 U.S. net farm income of nearly $55 billion, a drop of 3% from 2015. The agency will update its estimates in August.